Sam?
Yes.
Okay. Just confirm me once the screen is shared. So today we are doing what? We are continuing with the slide.
Yeah.
Okay, let's do. And I guess that you have revised everything, whichever we
I
have done for basic, discrete, and the contract that chapter 7.1.
Yes, I have.
Okay, future and swap contracts.
Yeah. We're just remaining with bear, bull, and box spread and ratio.
Yeah, we'll start with that. Let's see. More or less is done. So
Yeah.
do nicely tomorrow. Do the sums very nicely. Take time and do the calculations. Okay. Okay. So chapter 6 we are going to do today. Last day I did till slide. Okay, I have written. Let me open it. The sums you have practiced, all the sums you are doing.
Yeah, I
Good.
have.
You're telling me. Yeah. So last day we have done till
We finished butterfly spread, so
butterfly spread we have done.
yeah. Slide
Yesterday,
61. That's
chapter 6 now 45.
yeah.
Okay. Let me open your slide. 45 we have done.
Oh, no, we also finished 45, the arbitrage opportunities. We finished.
So from 46
It's from actually 51.
that we have done.
We have finished till 50, the butterfly spread.
Butterfly spread we have
Yeah.
done. Okay. Just let me open your PPT.
Mm.
Chapter 6 no. So what was the butterfly spread?
It's long at
Yes, we have
the,
done some also.
yeah.
You have noted down everything which I have given you as notes.
I have.
Okay. So tell me from there what I told you.
For butterfly spreads, there are three things involved: buying
Mm-hmm.
one low strike, buying one option with low strike call, selling two middle strike calls, and then buying one high strike call again.
Okay.
Yeah, and then it has a tent-shaped payoff diagram. For the
Yes.
maximum profit is the one which creates the tent shape.
Mm-hmm.
Yeah, and the maximum profit is like the stock ends near the middle strike, and
Yes.
the yeah.
So from 50 you are telling me I will start.
Yeah. I already did the diagram by myself, so that's okay. I think we can continue with like bear.
Okay.
Yeah,
Okay. Yeah, your PPT is getting open. Once it's open, we will start.
no problem.
40, 34. From 50 or 51 you are telling me?
51.
From 51. 6.16 up. Put call parity. What is the sum? 90. That sum you have done on your own.
Which one?
On slide 50.
Yeah,
Or I have done.
I have already done it.
Okay, you have done.
Yeah.
Okay, the diagram I told you, the V-shaped triangle I discussed. Yeah, I have done. Good.
Yes.
Butterfly spread I have done with you.
Hmm.
And I have done the sum also.
Yeah.
Okay. Now we come to bull spread.
Yeah.
So what is a bull spread? You have
Buying,
done?
yeah, I revised buying one low strike call and then selling one high strike call.
Okay.
Yeah.
You can see the screen?
Yes.
Okay. So what is a bull spread? A bull spread is used when we expect the stock price to rise moderately. Okay. What it involves then? It involves, buying an option at a lower strike price
Yeah.
and selling a similar option. Same type call or put at a higher strike price. So, this limits both profit also and risk also.
Yes.
Okay. So first you buy a call with 80, with strike 80, okay. And then you sell a call with strike 120, highest strike. So what is the payoff finally at expiration if we go with this? Again, the case we go, okay. Case 1, you have ST less than equals to 80, okay. So both auction expire what less? So losses net premium paid. If it is case 2, then 80 from ST to 120. So long 80 call off means ST minus 80 and short 120 call payoff means 0. So net payoff is what? ST minus 80. And if it is case 3 is ST greater than equals to 120. So that is long 80 call payoff is 120 minus 80, that is 40, and short 120 call payoff is ST minus 120. So what is the net payoff then? 40 minus ST minus 120. Profit profile is a maximum loss is the initial net cost of setting up spread. Okay. And what is the maximum profit? Difference between the strike. That is 120 minus 80. 40. Payoff diagram, you see first it's flat, rising slope between 80 and 120 and then again flat after 120.
Yeah.
So both spread is limited profit, limited loss. Limited profit, limited loss. This is the thing. Okay. Next. Okay, you have a sum. How we do the sum then?
We have to calculate the payoffs first, right?
Buy call at strike 90 and strike 100.
Yeah.
So net cost will be 15 minus 10. So that is 5 net cost outflow. So for the A, the payoff will be if ST less than equals to 90, then both what less? Losses minus 5.
Minus 5, yeah.
And if the same way I showed you, ST 100. So then it is long, if I tell long 90, call payoff. So that is ST minus 90. Okay. And what is short 100? Call payoff, that is 0. So then the net payoff will be ST minus 90. So that is minus 5.
Yeah.
Now if ST is greater than equals to 100, then long 90 call payoff will be 100 minus 90. 10. So short 100 call payoff will be minus ST minus 100. Okay. But since both strike 100 and above, the difference is 10. So what is the net payoff? 10 minus 5. So that is 5. So here the result, what is the maximum profit? 5. When ST is greater than equals to 100. What is the maximum loss? 5. So here when ST is greater than equals to 100. And here when ST is less than equals to 90. And here it is the break even. Break even means 90 plus 5. So that is 95. This is one. Next we have put bull spread. 90 to 100. That given. So again, here what we have 15 and receive 5. So that is 10. That is the outflow. So what is the payoff at expiry? If ST is greater than equals to 110, both what less? Loss minus 10. But going little bit fast because if I can complete, I'm trying.
Yes.
110, yeah. So long 110 put payoff. That will be 110 minus ST. If it is short 90 put payoff, then it is 0. So what is the net payoff? So 110 minus ST minus 10. Okay. And if ST is less than equals to 10, 90 it is given. So long 110 put payoff is 20. Okay. And what is short 90? That is minus 90 minus ST. Okay. But
Yeah.
see, ST is less than equals to 90. So payoff difference is how much? 20. So what is the net payoff? 20 minus 10, 10. So again here, what is the maximum profit? 10. When ST is less than equals to 90. Maximum loss, it is 10. When ST is less than equals to 110. Break even, 110 minus 10. So that is 100. So call bull spread, maximum profit 5, maximum loss 5, BEP 95. Here 10, 10 and 100.
Yeah.
Next. Beer spread. What is beer spread? A beer spread is used when we expect the stock price to fall moderately. So it involves what? Buying an option, long an option at a higher strike price and selling a similar option at a lower strike price, say K1. Okay, and here K2. So, this limits both profit and risk. Like here you sell at K1 here and you buy a call at K2. High street. This is opposite. So what will be the case here then? ST less than equals to K1. Both calls expire what less? Or K1 between ST between K2. So short call payoff is minus ST minus K1. And case 3 is ST greater than equals to K2. So short call payoff minus ST minus K1. Okay. So what is the profit profile? Maximum profit is difference between strikes. K2 minus K1 minus net premium. When it occurs if stock stays below K1. Okay, this is one. Maximum loss limited to net premium structure. Occurs if stock rises above K2 for this one. And payoff diagram, flat at profit for low, which you can see. This is beer. Next, again a sum for beer. Okay, so I think they have given one concept and then one sum. Let's do. Try it, 6.18.
Yeah.
What is the call beer spread? You see, you sell at 100, you receive 10. You sell, buy the call at 110, you receive 5. So call bear spread net premium is plus 5.
Yeah.
So again, same for everything you have to do a payoff.
Mm.
Like if ST is less than equals to 100, then both call are what less? Why? Because the profit is plus. If 100 ST 110. So then what is the short 100 call payoff? Minus ST minus 100. Okay. And what is long 110 call payoff? 0. So from here you get the net payoff. And if ST is greater than equals to 110, then what is the short 100 call payoff? Minus 10. And what is the long 110 call payoff? That is plus ST minus 100. So what is the net here? Minus 10 plus ST minus 100. So that is minus 10 plus greater than equals to 0. Okay. So at 110, it's minus 10 plus 0. So that is minus 10. So the final payoff is minus 5. So the result like this. B, how the B will go then? Tell me. You sell the put at 90, you receive 5. You buy the put at 110, you pay 15. So net premium is
10.
minus 10. Debit, no?
Mm.
So again the payoff. So if ST is greater than equals to 110, both put what less? If 90 ST 110, then it is long 110 put payoff and short 90 put payoff. And if ST is less than equals to 90, so then long 110 put payoff is 20, short 90 put payoff is minus 90 minus ST. So what is the difference? 20. So net payoff is 20 minus 10, so that is plus 10.
Mm.
Till now, any question?
No, no.
Okay. Next, combining the options. Okay, interesting. So you combine the option to obtain the same profit. Then what you get? What is a box spread?
Mm. It's the bear spread plus.
Yeah, a bull call spread, like you buy call at low strike and sell call at high
High
strike.
strike.
And here you buy at high and sell at low.
Low.
So bull means high, going to high. And
Mm.
bear means going to low.
Low.
Bull, the logic is a bull call spread guarantees a payoff of K2 minus K1 when the stock is above K2. And
Yes.
the bear put guarantees a payoff of this because it is going to low bear. So
Yeah.
together, no matter what the stock price is, the box spread K-off is K2 minus K1. So it's risk-free. Why it is like a bond? Since payoff is fixed at expiry. So it's equivalent to lending money now and receiving a guaranteed return at expiry. If the box spread is fairly priced, its cost today should equal the present value of K2 minus K1, which is discounted as a risk-free rate. So you see at strike K1, you buy call plus sell put. So you creating a synthetic long forward, this one. Next, you sell call plus buy put. So you are creating a, this is together, okay.
Mm.
So it's a synthetic short forward. I hope you remember the concept.
Yes.
Synthetic long forward. So combining them, you get long forward at K1 plus short forward at K2.
Mm.
So box spread payoff is constant. K2 minus K1. Box spread is a combination of bull and bear. It always produces a risk-free payoff equal to the difference between two strikes.
Yeah.
Again, we have a sum. So slide number 56. Calculate the current stock price and create a box spread.
Box spread.
How we do this? 90 to 100 and 100 to 110. So we need to construct a box spread is bull plus bear. So what is the bull call spread? Hundred to 110.
Yeah.
Buy call at the rate 100. So you pay 10. You sell call at the rate 110.
We receive
You
5.
receive
Yeah.
net cost
5.
10 minus 5, 5.
Yeah.
Beer
Yes.
110. So you buy put at 110.
10.
So what do you pay? 15.
0.
You sell put at 100. So you receive 10. So what is the net cost?
Minus 5.
15 minus 10. 5.
Yeah.
You pay 15 and receive 10. Okay. So the total cost is 5 plus 5. That is 10. What is the payoff at expiration? So box spread always pay K2, K1 at expiry. So here K2 minus K1 is 110 minus 100. So that is 10. So the guaranteed payoff. So what is the profit then finally?
0.
Payoff minus cost. So that is 10 minus 10, 0. Good. Next, ratio spread. What is the ratio spread? When you buy M options, long spread, and
Yeah.
you sell N options at different strike price, at K1 and suppose at K2. Okay, so typically it is N greater than M. So you sell more than you buy. So the ratio creates an asymmetric profile. Like here you see you buy one call at strike K1, I told you, and sell at K2. So relationship is this one. So for a low stock price, say SC less than equals to K1, all call expire worthless. So in that case, what will be the net payoff? Initial premium effect. Okay. And for moderate increase, it will be K1, ST, K2. So that is long call at K1 gains value, short call at K2 are still worthless, and net position is profitable. And for large increase, ST greater than K2, so long call gains, but two short call lose even more. So here the net payoff starts to decline and can turn negative. Ratio spread allow you to profit from moderate moves, but they carry unlimited risk if the stock rises sharp. So they are often set up with no initial cost or even at a net credit, making them attractive to trader betting on low to moderate volatility. So ratio spread combine long and short options in unequal number. Like you buy one call at K1, sell two call at K2. It profits if the stock ends near K2, but suffer large loss if the stock rallies too far. Ratio spread. Next, sum. So you buy three calls at strike 100. So that is 3 cross 10, 30. And you sell 410. So 4 cross 5 is 20. So what is the net cost? 30 minus 20. So that is 10. That is your outflow. Okay. What is the payoff at expiry?
Zero.
So first ST be the stock price. So first case 1,
Mm.
100. So here all caller what less? So payoff is minus 10. What
Mm.
is case 2? 100 ST 110. So each 100 call payoff is ST minus 100. For 3 calls, it is 3 ST minus 100. Okay. And 110 calls what less? So what is the net payoff? 3 ST minus 100 minus 10.
Mm.
And third is case 3. So that is ST greater than equals to 110. So each 100 call payoff is ST minus 100 for 3 calls. 110 call payoff is ST minus 110 for 4 calls. So what is the net payoff then? 3 ST minus 100 minus 4, 110. 3 ST minus 300 minus 4 ST plus minus 10.
Mm.
Minus ST plus 130. So payoff summary, ST less than equals to 100, payoff minus 10. 100, 110 ST rises linearly and then declines linearly.
Mm.
So what is the maximum loss then? At ST 100, what was the payoff? Minus 10. At ST 110, what is the payoff? 3, 10 minus 10. So that is 20.
Yeah.
Beyond 110, the payoff as minus ST plus 130. So at ST is equal to 120, payoff will be minus 120 plus 130. So that is 10. At ST is equal to 130, payoff will be 0, break even. Tell me if there is any question.
No.
No?
Yeah. No question.
Next. Caller. What is a caller?
A short call. Long put plus short call.
Caller is, it provides constant payoff. A
Yeah.
caller involves holding a stock and using option to cap what? Both the upside and the downside. Okay. So
Yeah.
here long put, put a lower strike price, that is K1.
Mm.
And short call at a higher strike price. So this creates a band of return. You won't lose more than a certain amount and you won't gain beyond a certain point. So let us draw down the payoff profile for this then. That is the main thing. We have to do the sum.
Mm.
So see if stock price is less than K1, then the put kicks in. Okay, so the portfolio value stays at least K1. If K1 is less than equal to S2, K2, then you benefit from stock price change. And if stock price is greater than K2, then the short call cap your gains. You give up upside. So payoff is flat, below K1, but increases linearly. So what is the return caller? The opposite. Short
Mm.
put plus long call. Short put means lower strike and long pull call means higher strike. This creates exposure. When you lose, if price falls below K1. Okay, and price only if stock rises beyond K2. And flat between strike. Okay, it is commonly used by investors to hedge portfolio, but it
Mm.
can cost less if the premium received from selling the call offsets the cost of buying the put. It provides a constant payoff back. Here again an example. So here, what is the collar structure? You buy at 100. So cost is 10. You sell at 110, so you receive 5. So what is the payoff at expiry? ST greater than equals to 100. So long 100 put payoff, that is 100 minus ST.
Yes.
And short 100 means 0. So net payoff is 100 minus ST minus 5. Okay, this is case 1. If I talk about case 2, 100 put is 0 and 110 call is 0. So net payoff is minus 5. And third one, case 3, S3 greater than equals to 110. So 100 put is 0 and 110 call is minus ST minus 100. So what are the key payoffs then? At 90, payoff is plus 5. 90, what is the payoff? 5 minus 5. 100, payoff is 0 minus 5. So that is minus 5. At 110, what is the payoff? 5. Flat. At 120, minus 10, minus 5. So that is minus 15. So the long put protects downside below 100, but we pay a cost. The short call caps upside beyond 110, making loss. And unlike a protective collar with stock holding, here is a pure option collar. So 100 minus 110 collar cost, 5 initially, maximum loss, unlimited downside.
Yes.
Next. What is a collared stock? A collar applies to a stock position, means you own the stock and then you buy a put and then you sell a call. So this creates a band. And what is the payoff structure for the same? If stock price falls below K1, so then the long put guarantee you can sell at the stock at how much? K1. So you are protected from large loss here.
Yeah.
Here. Now, if stock price stays between K1 and K2, so then you keep the stock return in this middle zone. And if the stock price rises above K2, then the short call obligates you to sell the stock at K2. So your gains are capped. So what is our profit profile? Floor minimum. So that is K1. Correct. You cannot lose below the strike. 1. If it is ceiling, then maximum value, so it is K2. You cannot gain beyond this strike and it is beyond K1 and K2. So you write stop. Movements normal. Why use a collared stock? Why we use a collared stock? Hedging. First is hedging. Protect against large loss while still leaving room for some cost efficiency. So the premium earned from selling the call helps finance the put, sometimes making it a zero cost, and risk control. So ensure you lock in a minimum value for your stock, which is useful when markets are volatile. What is a written collar? It's just the opposite.
Yeah.
Short put plus long call. Short put at lower strike plus long call at higher strike. So this creates exposure when you lose heavily if price drops, profit if price rises above the highest strike. Okay. So this is often used by speculators willing to take on risk. So collared stock is stock plus long put plus short call. So it creates a protective band. You can't lose more than and you can't gain more than. Between strikes, you keep normal stop loss. Okay. It's a recap.
Yeah.
Okay. Again, it is there. Okay, let's see how much we can do.
The
Let's
rest
continue.
is mostly just theory. Yeah.
Okay. Okay, let's continue with that only.
Yeah.
I'm going slide by slide then, okay?
Yeah. No problem.
Then it will be a recapitulation with me also with you.
Mm.
So here it was synthetic forward. What was that?
Purchased call plus return put.
Buy a call option
Mm.
and sell a put option.
Yes.
So an option-based strategy that replicates the payoff. How it works? If stock price is greater than K, that means call is exercised.
Exercised. Yeah.
Okay. So you buy the asset at strike K, now put expire worthless. So same as long forward. And if stock price is less than K, then call expire worthless. So put is exercised against you. You must buy. Why it is artificial forward? Instead of entering into an actual, you replicate the same payoff using option. So synthetic forward payoff is stock price at expiry minus the strike price. And this is identical to a standard long forward contract. Okay.
Mm.
Next. Put call parity was what? Fundamental relationship in option pricing that link the price of European call and put with the same strike. And what was the formula? CKT is equal to CKT and for this. Okay.
Yeah.
Call option price, put option price, and present value. And for a non-dividend, the second one, this one.
Yes.
If the parity relationship doesn't hold, arbitrage opportunity exists. So if call are overpriced relative to put, trader can log it. And what is the combining option? Straddles.
Strangles.
Strangles. Straddle was long call, long put, same strike. Long call, long put, different strike. Spreads we did bull, beard, butterfly, box ratio spread, and finally the collar. Stock, long put, short call. Put call parity ensure consistency between option price and prevent arbitrage. The formula we've seen, and by combining option, we can create synthetic forward and various structured payoff like spread, collar, and straddle. Next, this only we have read. Now, limiting. So, what is the seller's risk? Hedging by the seller of an asset. If you are a seller of an asset, for example, a farmer selling wheat in 3 months or a company exporting. So the price of the asset might fall before you sell it might be. So that means you would receive less money. So there are hedging opportunity. So to limit this downside risk, seller can use derivative. They can enter a short forward or a put option. Like I was discussing with you that you can do like that. So hedging means short forward means you enter a short forward at today's forward price. This locks in the selling price in advance. Then what will happen?
Sorry. Yes.
Repeating. Hedging to limit the downside risk, they use derivatives. So hedging approach. So first, short forward contract means you are entering a short forward at today's forward price. This locks in the selling price in advance, and maturity, regardless of the market fluctuations, you are guaranteed to sell at the agreed forward price. Okay. So
Yes.
here there is an advantage. What is the advantage? It eliminates price risk entirely. And what is the disadvantage? It removes any benefit from a price rise. Okay. What is the buying a put option? You with the strike price, it is equal to your desired minimum selling price. So this creates, a price floor.
Mm.
That means if market price fall below the strike, the put guarantees you can sell. Now, if market price rises above the strike, you can ignore the put. Now here there is also an advantage. What is that? Downside protection and ability to benefit from upside. Correct?
Yes.
And if you talk about disadvantages, then you must pay a premium for the put. So short forward, complete certainty, long put, insurance. Next. Okay, hedging with a forward contract. There is a diagram. A very interesting diagram they have given for gold.
Yeah.
It is costing lakhs. Okay. So what is hedging with a forward contract? A short forward contract is used by a seller, who wants to lock in a future selling price for their output. Like by entering a short forward, the seller fixes the selling price today regardless of the future 5 movement. Just see your diagram. Here it has
Yeah.
hanged. If you went like slide 65, suppose a gold mining company expects to sell gold in 1 year.
Mm.
Today they enter a short forward contract at how much? 420.
Mm.
This guarantees them what? A fixed selling price no matter what happens to gold. Now the payoff diagram, the diagram compares 3 situations if you see. Unhedged seller, short forward contract, hedged seller.
Hedge seller.
Unhedged seller means if gold price rise, seller gain more revenue. If gold
Mm.
price falls, seller suffer loss. This profit is uncertain and it is entirely depending on what? Market price. Short forward contract, only forward payoff. Profit or loss move in the opposite direction of gold price. If gold price is greater than 420, forward loss, money. If gold price is less than 420, forward gain, money. Hedge seller, actual position is gold production plus short forward. That means the seller physical gold revenue goes up with price. The forward payoff goes down with price. Together they cancel out the price risk. So leaving a flat profit line. So what is the net effect? The seller is guaranteed to sell at 420 regardless of whether gold is 380, 420 or 500 in 1 year. So what is unhedged seller? Risky, exposed to price fluctuation. Short forward alone, risky, opposite exposure to gold. Hedge seller, eliminate price risk. So by using a short forward, the gold mining firm can lock in on a selling price.
Mm.
I cannot write anything or cannot show you the
That's okay.
I'm explaining. Just listen to me carefully, okay?
Yeah.
Next, buying a put option. I'm on slide number 66.
Yeah.
So what is a put option? A put option gives the right to sell at a specified strike price.
Mm.
You buy a put, a seller can guarantee a minimum selling price while still being able to benefit. Let's see your diagram. A gold mining company is worried that gold price may fall.
Yeah.
Excuse me. So they're buying a put option with strike 420. Now what is the premium cost?
8.77.
3.77.
Mm.
3.77.
8.77.
8.77. Exactly. Now it has come. Last diagram is clear, I guess so.
Yes. Yes.
This one is the diagram. So
Mm.
here 8.77. Good. Here it is. Now the payoff structure, the diagram, unhedged, purchase put, hedge seller. So profit rises as gold price rise, profit falls at gold price decrease. Purchase put means below 420, the put increases in value. See? But
Yeah.
above 420, the put expire. And if price is less than 420, then the put guarantees. If price is greater than 420, the seller sells. So only cost is the premium paid. That is, by buying a put, the gold mining firm ensure they will never sell for less than this. Okay, while still enjoying higher profit if gold rises above this. Next. Limiting. So buyer worries about future price. So hedging helps to limit this. And here what are the two hedging methods? Long forward contract. That means buyer enter a long forward, this locks in the price, they will pay in the future. Remember, benefit full protection, but no benefit if price falls. That is a condition. And if you are buying a call option, that is also a hedging. How? With a strike price. So they will never pay more than the strike price. No, if market price are lower, then they buy at a cheaper market price.
Yeah.
So it's protecting against the high price while still benefiting from lower price. Okay.
Mm.
Like an airline worried about jet fuel cost, if it buys a long forward, it fixes the price of fuel. If it buys a call option, it caps the maximum price it will pay.
Yeah.
Next, hedging by the buyer and asset. So here a long forward contract, allow a buyer to lock in a price for their input. So by doing this, they protect themselves from rising price, ensuring cost of firm uses gold as an input. Now he agrees at what? 420 in 1 year. So what is the payoff logic? See, if the gold price rises above 420, then the unhedged buyer must pay 460. The hedge buyer pays only 420. So
Mm.
buyer gains protection. But if it is below 420, then the unhedged buyer benefits 380. But the hedge buyer still plays 420. So buyer loses. So unhedged buyer profit fall as price rises. Long good forward profit rises. The dash line, if you see, linearly with the price. And hedge buyer, the solid line.
Yeah.
Profit is flat at 40. Only the explanation we have to understand.
Mm.
New. This one again, you can explain me. So call option gives the buyer the right to buy an asset at a fixed price. For an input buyer, buying a call act as an insurance. So here 420, 8.77. So gold goes above 420, they can still buy. If gold stays below 420, they just buy at the lower market price. Now the scenario, less than 420, that means 380. So you buyer ignore the call and buy at 380.
Mm.
Okay. And
Yeah.
the cost is 380 plus 8.77. So that is 388.77. And if it is gold price is 420, then call has no intrinsic value. But if it is greater than 420, then buyer exercise the call. You pay 420 instead of 460. And what is the net effective cost? This plus premium.
Premium.
Next. Okay. Oh, reasons to hedge.
Yeah.
They can give you a question, and by now we have done many reasons to hedge, like we have already done. I have already told you that only, and they have given eventually the slide.
Mm.
Tax advantage of tax rules.
Yeah.
So some tax system favors stable class. By hedging volatility, firm can optimize. Till the diagram, any question anywhere?
No. No.
No, from sums.
No, no.
Okay. Avoid large loss leading to bankruptcy means extreme loss can cause financial distress. So hedging limits downside risk. Costly external financing. So if firms face sudden loss, they may need to borrow. Increasing debt capacity, lender prefer firm with stable, predictable earning. Managerial risk aversion, manager often dislike uncertainty and non-financial risk management. Beyond finance, firm face operational risk. So hedging provides stability in planning, production, pricing, and supply. It's not just about making profit. It's about protecting value, improving stability, lowering financing cost, and reducing exposure to unexpected shocks.
Hmm.
Reasons not to hedge. Interesting. Ah, but it's more, advantages more. We have done
Yeah.
practically also. So they might give you transaction costs, like you enter into forward, future, or option contract that isn't free. Brokerage fee, bid-ask spread, margin requirement. For small firms, this cost may outweigh cost of expertise. Hedging requires skilled professional. Hiring or training such experts because they will decide. Monitor transaction to prevent unauthorized trading. Derivative contract can be misused. Firm must implement internal contract without oversight, okay? And complications in reporting. So here, accounting standards require complex hedge accounting treatment, recording derivatives on balance sheet, marking to market, and showing fair value adjustment. Tax rule may also reduce the net benefit of hedging. While hedging helps reduce risk, yes,
No, no, no. Sorry.
it is not always practical.
Mm.
Firms may decide that the cost, complexity, and administrative burden of hedging outweigh the potential benefit. And this ends your slide.
Slides.
Uh,
Yes.
So finally, we are able to finish the syllabus
Yeah.
before your exam.
Yeah.
So tell me from anywhere you are having any questions.
Not really. No.
Not there?
Yes.
Just revise today what we have did. I don't think so you face any problem because
Yeah.
it is just what the types of things were there and the same, and last only the interpretation.
Yeah.
Just revise one set, then it will be done, and practice the sums
Yeah.
because those were important.
Okay.
Okay,
Yes.
how are you now?
A bit better. Yeah.
Better? You can
Yes.
give the exam tomorrow, correct?
Yeah. I have to. No choice. Yeah.
Okay, they won't do it later. So you can give
Okay.
the exam. I think so. You are better like
Yeah. No,
previously.
I can give it. I think I'm pretty confident.
Okay, very nice. And you have done very nicely. The questions which I have asked with you also, you have done very nicely. So it's very goodly done. So you give it because again, then you have to read. That
Yeah.
is what quickly it's being refresh, fresh one. You just give the exam.
Yes.
Okay.
Yeah.
So no questions for today then.
No. No. Okay.
Okay, then.
Thank you
Okay.
so much.
Yeah. Best of luck for your examination.
Oh,
Okay, and as I tell for the sums,
yeah.
give it a time
Mm.
and then do it very nicely. Okay, don't be hurried because the sums, calculation mistake that I don't want.
Yeah.
Okay, and the questions which are there, that too I hope you can do because we have done very nicely all the questions, each and everything which is there.
Yeah.
Okay, so
Yeah.
that you do very nicely. Okay, then.
All right.
Okay,
Thank
okay.
you.
Thank you. Yeah, thank you.